Good afternoon, everyone. My name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation in just a moment. Some other people are logging on. I want to give everyone a chance to sort of get settled in before we start. For those of you who have logged on, you are in mute-only mode, which means that I can hear you, but you can't hear. You can hear me, but I cannot hear you. If you have questions, please type them into the question box on the lower right-hand side of your screen, and we're going to get to them after the main body of the presentation. For those of you who have to leave early, this session will be recorded, so you will have access to the video and the audio later. So in case you have to leave, you can find out whether the butler did it or not. You will get copies of the presentation. They'll come out in the next day or two. So I'm going to go away now for about a minute or so, and when I come back, we will start the presentation. Well, good afternoon, everyone. For those of you who have just joined, my name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation now, the impact of CECL on banks and their corporate customers. Ethan Heisler is going to talk about how CECL has impacted sort of both sides of the table, corporates on one side and banks on the other. And then after the main body of the presentation, we will get to the Q&A side. If you do have questions, please type them into the question box on the lower right-hand side of your screen, and we'll get to them after the presentation. The presentation is being recorded, so if you have to leave early, then you will get access to the video, and there will be some copies of the presentation going out afterwards. So with that, I'm going to turn it over to Ethan. Are you there?
Yes, I am. Thanks, Bruce.
Go ahead, please.
Okay, thanks. Thanks very much. And hello, everyone. Thanks for joining us on the call. So I know you have my bio. I won't go too far into that except to say that throughout my 40-year career working with financial institutions, both as a bank regulator, a bank analyst, a bank consultant, and an advisor, I have always focused on accounting issues because with banks, because when you go to a bank, there really isn't anything there. It's not like you see a pile of gold or, here's where the loans are or something like that. Everything is based on the value of money. Well, if all the financial statements all the basis of a bank rests on GAAP accounting, then accounting really matters to a bank. And we'll talk some about that. The goal of today's presentation, as I was charged, was to speak to an audience that was interested in how this accounting rule that you may have heard about has impacted on the banks that you might be dealing with. So typically, I speak to other financial analysts or other banks about banks. I'm anticipating speaking to a more general view audience. I promise not to get into the very nitty-gritty of accounting, even though I'm fascinated by the subject. So I'm hoping that you will be as well. I guess, well, let's take a look at the agenda page. So this is the agenda that I put up. I think it's a lot longer than I anticipated a page of a presentation to look like, but this kind of gives you a roadmap what I want to talk about over the next 30, 40 minutes. So I want to give you a brief history of 50 years of debate about the timing, estimation, and recognition of credit loss. I mean, just as a concept, where this started, it really all goes back to FASB when it started in 1973, and it's been continuing up until today about law. So we'll talk about that. I expect you to come away with everything you ever needed to know about CECL, but don't really want to ask. How does this compare to, if you're dealing with a U.S. bank, or your lender is, say, a Canadian bank or a European bank. U.S. banks follow CECL. Canadian, European banks, they follow IFRS 9. It's like CECL, but it's not exactly like CECL. I want to get a little bit into the nuances of that for you. And I'll show you some analysis I did recently on Canadian banks and comparing them to U.S. banks, just so you could see what the effects of this have been. Then the next objective is to give you some sense of what are the sensitivities around CECL. So, if you take credit card loans, for example, are the longest duration assets on a bank's balance sheet because they revolve forever. So they're treated as long-term assets. The longer a loan, the more reserve a bank has to take. And why is that important? Well, it gets to this next bullet point, which is, we're going to need to understand how bank capital accounting works. As I say, it's sort of like, I've been long saying that accounting is bank regulation by other means. Typo there. Accounting is bank regulation by other means, or essentially regulatory capital weaponizes accounting rules, and we'll talk a little bit about that because it filters into whether you go to a non-bank lender or a regular bank or commercial bank, how the accounting rule changes the thinking and the strategy. And then from there, once we've got that covered, we've got to talk a little bit about how COVID came into the whole picture here, because CECL was implemented this year. IFRS 9 was implemented the year before, but CECL was implemented in the beginning of 2020, and we all know what happened shortly thereafter. So that whole thing has changed the nature of the conversation about what CECL is and what we thought it was going to be and what it turned out to be. So we'll go into that. And then the last thing I guess I wanted to spend a little time is because I've spent my career as an analyst and dependent upon publicly available information. FASB's goal was to improve the transparency of the credit exposures for lenders. I want to talk a little bit about whether or not that's actually true, whether or not investors truly understand, or financial analysts, if they truly understand. I'll give you a few comments and observations about what my takeaways from the question and answer sessions that bank analysts have on the quarterly calls with banks about CECL disclosures, to give you some flavor of that. So, okay, so that's my agenda, and rather than have you look at this very boring slide that we're already going to just talk through, I thought I'd give you something else to think about, because CECL also came out when this poor lion was murdered. So I forever have associated, and I figured we could look at that while I tell you an interesting story. So back in 1973, as I was talking about earlier, the FASB came into being. Right? I think before that it was the SEC that was making accounting rules. There were other. FASB basically formally started handing out accounting standards in 1973, and immediately went to work on an accounting standard for the recognition of loss. It was called SFAS number 5, and it was it basically espoused the incurred loss method. The incurred loss method basically says that when I can have a demonstrable evidence that there is a loss that's going to occur in my loan portfolio, even though I haven't fully absorbed that loss yet, the accounting rules say I need to recognize, I need to provide for that loss ahead of the charge-offs for those loans that I will eventually do. And I hope that I'm not losing anybody. I'm just trying to give you the basics, but this is important to understand. So basically from 73 to 89, and talk about second why 89 is that demarcation point, up until the financial crisis in the late 80s, early 90s, basically. The accounting for loss recognition in the United States was all about whatever anyone thought loss should be, short of providing for the loss on the day you write it off. So, I make a loan today, it's a 5-year loan. Say 2 years from now, the loan starts evidencing some problems. The borrower has some credit issues, but he's still making the payments. But, maybe he's going to have some problems. Like I don't recognize the loss at that point. So we go a little further. Let's say now he missed a payment, but he sent it in 15 days later. Well, okay, now that's a little bit riskier, but I still don't recognize a loss at that point. So I have nothing to really provide for. I'm watching the loan though. Then you come to, hey, he's actually missed a payment. He misses a payment, now the loan is non-performing, and then I make a provision for the loss because now something has actually occurred. And when it's been determined, usually at about a year, that borrower is never going to pay me back, that's when I start writing off the loan. And, there's various different dates. Some banks do 6 months, some they're doing 3 months, some make 9 months. It depends on the loan. But that was the basic idea. And every bank had their own way of doing it up until about the financial crisis in 89. It was a big commercial real estate crisis. For those of you who are not aware, Bank of New England famously failed. There's a lot of problems in the industry. Okay, so there, then you have this financial crisis, and the takeaway for people when you have these problems, the credit cycles in the world, regulators, people tend to want to take lessons. What are the lessons I should learn here? So regulators basically learn from their standpoint that banks were not recognizing these losses early enough. So basically, the loan was already past due 60 days and they hadn't taken the provision yet, that kind of stuff. Or, there was definitely evidence that the loan was going to definitely stop paying. But, before they could estimate, they didn't even try to estimate or prove the loss. They delayed. So they wanted, no, we're going to push the banks. We want you to have it provide for losses before the loan stops paying at all. We want much earlier in that life cycle of the loan to a loss scenario. So as a result, you had so that was interesting because the SEC, on the other hand, got in the mix of this, and they were very uncomfortable with the way the regulators were pushing financial lenders to recognize losses earlier because they were worried about understating capital and understating loss understating earnings for profits for a bank by overinflating provisions for credit losses that eventually banks would never even recognize. So kind of inflating their reserves, but as a result of which later on they won't need to take a lot of credit losses. They really wanted banks to have, from their standpoint, investors who were reading their financial statements needed to have a more certain idea of when credit loss was actually occurring. So famously, in 1997, I think it was 97 or 1998, the chairman of the Bank of SunTrust at the time was in the midst of an acquisition of another bank called Crestar. And he made the argument that, or he suggested in the press or to analysts that, the reserve really was really at his discretion to decide when, how much of a reserve he needed to take, how much provisions he really needed to take. He was emphasizing that. And that's when the SEC really cracked down. And in 2007, we were in a stage where banks went from very early recognition of their credit losses, say in the early 90s, to a much later recognition of their credit losses by the eve of the financial crisis in 2008. And as a consequence of that, the Financial Accounting Standards Board, the bank regulators, and the SEC all joined in support of pushing the recognition of loss to the day that the loan gets funded. So no more I write the loan and I don't take any provisions on the day one because it's a past loan, and I really wait till there's some problems in it before I start taking a provision. Now, every single loan that you write on the day that it gets funded, that has to be provided for. And so that's the idea. Now, let's talk a little bit about what CECL is about. So we said that, you recognize the losses in a loan, whether it's past or it's already in trouble, on the day that the loan gets funded. And now, so what's going to be the sensitivity of that? So first and foremost, the longer the loan duration, like we were talking about credit cards before, the longer the duration of the loan, the longer the maturity, then the larger the reserve. And that makes sense, right? Because, a 10-year loan is going to have a much higher potential loss than a 2-year loan. Hey, just think about it in terms of life cycles. I mean, every loan has, you start out pretty strong, and then there's a credit point where, losses start to filter into a loan portfolio. Some of those types of loans could be, in 6 months you could start to see these losses. Sometimes you could see it in a year. Sometimes you could see it in 2 years. It depends. Commercial real estate, some of those loans could be a couple of years before you start to see loss emergence. So given that, you overlay the type of loan that you're making, which has different levels of different terms for the loss emergence, and you overlay that on timing within a credit cycle, and you have the basic idea of what drives the provision for loan losses under CECL. So, CECL today, or at least the way this is operated, is that banks are taking this first day look. They have a model. They estimate where we are in the credit cycle, when we're going to start to see the loss emergence, and they put aside that provision on day one. On day two, and there was a day two. Day two is reserved for changes in the provisioning that you already made, assuming that basic model assumptions have changed. So, for example, it's January 1, 2020, and I take a reserve assuming that, maybe we'll see a mild recession in 2021, but there's no real idea that it's going to happen. So, you take, provision of X, then all of a sudden, I don't know, something happens. Let's call it a pandemic. And a pandemic happens, and suddenly your provisions for loan losses are going to be much, much, much higher. So you take a day two adjustment to your provision. That's essentially the idea behind the CECL. So I have some graphs that we'll take a look at that as well. So actually, why don't we do that? Let me show you this graph first. So this is drawn from the Federal Reserve Bank database, and what it shows are the reserve for loan losses for banks divided by their total loans. And I like this because it's fairly uniform. So the large banks are really the top 25 banks. All of these top 25 banks follow CECL. The small banks are the other 4,900 institutions in the U.S., about 90% of which do not follow CECL yet. Now, in the next year, many of these banks are going to have to adopt CECL. But we'll talk about where that stands, because there's some accounting changes that were introduced through the CARES Act that flow into this. But let's just say for now, everything you see here, the blue line reflects the banks that are following the old accounting model, and the orange, brown line, gold line, represents the top 25 banks that are following CECL, the new accounting model. And so you see this huge divergence right in the beginning of the pandemic. Now, I want to caution you as you look at this graph to understand that there's more than a difference of large versus small for this graph. There are, yes, so the large banks tend to, in addition to following CECL, also tend to have a lot of credit card loans. Their credit card lending is 96% concentrated in about 7 or 8 banks in the United States, of which Citi, Chase, B of A, and Wells Fargo are the largest, followed by obviously Cap One. Pretty much after that, you've really run the gamut of, and Discover, I suppose. Those are the banks that really manage all the credit risk in the U.S. for consumers. Student loans would be a second item on, but tends to be mostly on large banks. Commercial real estate is also a very long-term loan. You tend to see more commercial real estate at community banks than you do at large banks. So that's an offset to some of these numbers. And then finally, commercial and industrial loans, which tend to be 2-year type loans. Those loans are mostly concentrated in these top 25 institutions. So that's the differences between these institutions that you should understand. But like I point out, here you can see a significant divergence between what the banks in CECL did following CECL and what the banks who were not following CECL. So they clearly reserved a lower level. Again, we were in the midst of a pandemic in the early times, so you would have expected banks to add some provisions, but then something else happened. What else happened? Well, as you all remember, the CARES Act basically came in and sprayed a lot of money around. And obviously we're going to have another round of that. But the effect of it was that a lot of credit, and regulators also came in and told banks, just because the guy isn't paying you today, it doesn't mean that, it's really a non-performing loan. Don't treat it as a non-performing loan, which means don't provide for it if you're following your current loss method. So some of those moratoriums are going to start to run off now, and we'll see what that plays out. But the good news is that because the economy has come back as far as it's come back, it's ameliorated a lot of the credit problems that the banks following CECL were really trying to provide for in that first and second quarter of the year. So I think that's the key point to understand between how these two banks followed through this. In fact, let me show you one more slide. This is like seven large banks. This is J.P. Morgan, Citi, Bank of America, Wells Fargo, U.S. Bancorp, PNC, and Truist. And I just wanted you to see what the reserves for these major institutions who lend, how they change, so that you can get a little bit of a sense of the dynamics here of what CECL meant when it was implemented on January 1st, and then as we went through the rest of the year with this day 2 adjustments and so forth. So as you see at the end of the fourth quarter 2019, this was the actual state of the reserves for banks pre-COVID. This was what was considered a benign economic environment for them. Obviously, by the end of March, when they released their first quarter results, you had a massive change in the economic picture of the U.S. And so you see here a near 50% increase in those reserves, particularly at JP Morgan, at Citi, and at B of A. I think, I think less so originally at Wells Fargo. We saw a little bit more of that as we went through, and we should talk about that in a second. My basic point here is that the institutions with the most consumer exposure are the most likely to have been increasing their provisions. Also, the ones that obviously have exposure to the travel industry and entertainment and so forth. Okay, so let's go back. So I want to now talk for a few minutes about what is risk-based capital and how does this change the accounting, or how does this change the thinking about accounting? So there's a basic rule about accounting. Accounting is just accounting, right? It's not economics. Economics rule accounting. Accounting doesn't run economics. That's not really true. In the case of banks, it's absolutely not true. As I said before, the balance sheets and income statements of a bank, which is the actual only physical thing you'll ever see of a financial institution other than maybe the shopping center where it has a branch, is all based on accounting rules. And for banks, they have to meet a regulatory capital requirement for core capital, and the reserve for loan loss, which is determined either under the incurred loss method or under CECL. In either case, that incurred loan loss is deducted from core capital. So if you have a bank that, say has the 10% risk-based capital ratio as a result of having to put in a CECL reserve, sees that reserve fall by 10%, sees the capital ratio it has fall by 10%, that obviously could change its calculations for making loans. So banks are very sensitive about capital, the reserve for loan loss, how much reserves they want to hold, because that reserve gets deducted from their regulatory capital. So given that CECL is essentially going to substantively increase the amount of reserves and thus deduct the reserves from our regulatory capital, there was a lot of sensitivity of how that would play out. The CARES Act, importantly, changed the dynamics here because it essentially allowed financial institutions to phase in the day two effect of that we saw in the first quarter and second quarters of 2020, and going back to this slide. So anyway, that's the fundamental difference for regulatory capital and banks between, say, a bank lender and a financial company, a non-bank lender. So if you take a Quicken Loans, I don't know how many loans Quicken holds, but or Oryx or any type of commercial lender that's not a bank, there is accounting is just accounting. The reserve for loan loss, a higher reserve under CECL than you would under the incurred loss method, would not impact your lending decisions because you're guided by economics. But for a financial institution, and I think that's the key, for a financial institution, it reduces capital. And as a result of reducing capital, it could influence credit decisions. Now, I mean, I guess that leads me to talk a little bit about, I did promise looking at this. Let me show you Canadian banks, but before we do this, explain. So the idea behind CECL was to put an explicit reserve on the balance sheet for the expected credit loss in a portfolio. But the U.S. FASB, when they decided on the CECL model, actually went a different way from all the other global institutions. So the rest of the the international accounting rules that followed by European, Canadian, UK, Australian, all banks outside the US, that international accounting standard adopted something called IFRS 9. Now, we were talking about CECL. I recognized all my losses on day one, right? And, if there's any change in the model, any change in the assumptions, change something in the economics, like a pandemic, then I have a day two adjustment to the reserve. But otherwise, theoretically at least, I've put aside all the reserves that I'm going to need to absorb credit losses in our future portfolio, assuming no change in the portfolio, assuming a static portfolio. Obviously, that's not true because banks make loans run off all the time. But just for that loan portfolio, assuming it's always there. IFRS 9 takes the approach that loans get put into three buckets. So, we were talking much earlier about the life cycle of a loan. So loans, when I make the loan on the first day, every loan is a pass loan, right? Nobody makes a bad loan. Lending officers don't stay in their job if they do. So on day one, the loan is a pass loan. And the IFRS 9 accounting rules require that a lender put aside expected loss on that loan for 1 year of the loan term. So if you have a 5-year loan, you expect a certain amount of losses over the first year, you put aside that provision. And, if your loss emergence actually is in year 2, then, you don't have much of a provision at all. That's bucket one. Bucket one are basically loans that are pass loans. There are no problems with them. Then there's a second bucket. And the second bucket is for loans where there are problems. In the U.S., we call them special mention loans. They're criticized loans. They're loans where borrower's still making the payments, but he's suffering a lot of. He's in the hotel industry. You know that he has a motel by the side of the road. Nobody's going to go visit that hotel anymore. So eventually, he's going to fail on his. He's going to default on the loan. And there'll be losses. So you put aside some provisions. At that point, you shift from that first year to the expected loss on that loan over its lifetime. And then in the third case, you also, that's a bucket three. Bucket three are reserved for loans where you are you're actually already seeing default. And in that case, you not only put aside the reserve for expected loss over the life of the loan, you also put aside a provisioning. You also adjust your interest income that you earn on the loan to reflect that credit risk. So there's two adjustments that you make. So as I show you this next slide here, and you look at Canadian banks. What you see here, now keep in mind, their fiscal years are basically a month off. So, the fiscal year for Canadian banks started at the end of January. But what you are seeing is that, within 1 quarter, there was some modest change in some of the banks in terms of the amount. TD looks like they increased their provisioning. Perhaps reflecting some of the stuff going on in the U.S. You also saw a little bit at RBC. Again, these institutions have more U.S. exposure, but basically, while there was a modest increase, if you compare back to the way the U.S. banks were, the increase for U.S. banks in that first quarter after the cycle and in the second quarter particularly, we're talking about a doubling of the reserve. With the Canadian banks, you can see that reserve increase was much, much more modest, which basically goes to the effect that most of the loans were not seeing losses. And that gets to our second point. Why are we not seeing losses? Well, again, as we said, the Federal Reserve went through and they prevented losses for banks from recognizing non-performing loans. There was a lot of loan forgiveness. there were stimulus checks that were coming out, there were low interest rates, there were affordable programs, there was a whole bunch of different things that the banks did, that the regulators did, and the government did to avoid the actual loss recognition at some point. So that I think, gives you a little bit of a perspective that, if your lender is a TD, for example, and they're following IFRS 9, the real question is whether the loans that they probably have in their bucket 1 now move to a bucket 2 if we see a worsening in the credit cycle as a result of whatever happens with COVID, or whether the government stimulus programs and other efforts that they're going to continue with will help just push off loss recognition or actual loss emergence for forever, as I think a lot of institutions say. I mean, if you could think of it this way, the real question in this graph is whether the banks that are following the incurred loss method or have under-reserved for the credit cycle and will eventually have to increase their reserves eventually, or whether the large banks over-reserve because of CECL for these same losses. Eventually, the lines have to converge, is I think the point I'm trying to make here. So, okay, so we've gone through that. Now, I just, the remaining few more minutes that I have left. Oh, I should also show you this slide. This is just to show you that if you compare how much the reserves that U.S. banks did versus Canadian banks, the net increase over that entire life cycle that we just saw in these last 2 slides, that net increase was 17% to an adjustment for the day one of 53%. That was when they first transitioned to the new accounting rule, and then an additional slug of 62. But the basic point of this is a substantially larger toll that that CECL had that on U.S. banks and IFRS 9 had on Canadian and other international institutions, as you should understand. Okay, so kind of reach our conclusion. Has this accounting change improved investor understanding of the financial institution's business position to make for better informed investment decision making? That's my opening first question. And I thought long and hard about this. This was the promise of this accounting rule, but here's the problem. So we're now in this stage in the waning days of the worst part of COVID, with the vaccine and moving us to a bright future, hopefully. We're now at the point where institutions who did CECL provisioning are thinking about reversing these provisions over the next couple of months, next couple of quarters. And the issue then would be, do analysts really comprehend what this provisioning adjustment really means? So when I increase my provisions for loan loss, I understand that, and it usually precedes a credit cycle. In this case, I haven't actually seen the credit cycle losses. All I've seen has been an adjustment of increasing provisions earlier last year, and now presumably some reduction or reversal of those provisions, but without any evidence of a credit cycle yet. That's I think a little difficult for the way analysts look at this. I only caution that the bank analysts on the credit call, on the analyst equity calls, when they talk about CECL, they're all talking about whether or not, when are banks going to reverse the CECL reserves and that they took in the beginning of the year. And I guess the thing that the banks keep trying to explain to them is that there's a lot of moving parts to the calculation of what that CECL reserve is supposed to look like. We mentioned obviously where I am in the credit cycle. We mentioned what's the length of the loan that I'm writing. But another factor is also, am I writing new loans? Am I writing more loans, or am I writing less loans? This, obviously, if when you look at the banks, they don't break out. You don't break out the the actual reserve. It's a general reserve. So in order for me to understand why a reserve has changed, I should also understand how am I writing more or less credit card loans versus commercial real estate loans, or am I seeing a growth in C&I versus student loans or something like that, that will influence what that reserve is. So I think analysts trying to estimate future earnings and make informed analysis of for their model will have to struggle with CECL, particularly because there's nothing to compare CECL provisioning to. Bank analysts typically look at non-performing loans in a bank and compare that provisioning to the changes in non-performing loans. With this accounting rule, there's been no changes per se in non-performing loans. I don't have that slide, but all of this leads to, I think, more confusion than was existed under the old accounting. However imperfect analysts and the FASB and the regulators believed it to be. How does it impact bank lending in the U.S.? I think that my expectation in the beginning of this year, because of CECL, was that we were going to see banks reallocate capital from student loans and credit cards and other consumer exposures that were long-term duration and shift more into C&I. That was certainly part of the idea. We have actually not seen that. We've seen like Citizens Bank, Sallie Mae have sold credit card loan portfolios. I'm sorry, student loan portfolios. And we've certainly seen banks tighten credit underwriting for credit cards. So there is some of that. But the biggest challenge that banks have today is not their willingness to make a loan. The biggest problem that banks have today is the willingness of borrowers to get loans. So I think, all other things equal, could CECL have impacted bank lending? Perhaps. It certainly seems it should have, because from a bank standpoint, do I want to have a lot of capital wrapped up in a credit card portfolio that doesn't have enough return for the risk I put into it? Or would I rather have less capital tied up in a commercial and industrial loan with a potentially similar kind of return, but less capital, with capital held up through the reserve? The economics seem to argue that kind of an adjustment should be made. Is it just too early to judge everything? Well, again, like I said, COVID and the government's reaction to all of this just put everything on hold. In a normal credit cycle, CECL is made for credit cycle. CECL is made with the idea that there's a credit cycle. Whether it's a short cycle or a longer cycle, it's a cycle. COVID was not a cycle. COVID was a disruption, an economic disruption. And the reason we know that is that the bank loan lenders were not overextended on credit. I mean, this has been well documented. And it has been true. For the most part, you'll see that private equity, pension funds, life companies have stepped up their participation in the leveraged loan market from where they have been. And I think that has taken a lot of the problems that we've seen in previous cycles out of the equation. So anyway, we're just not in a normal cycle. CECL will need to be evaluated through a credit cycle. Probably not this one, but we will see. That's the key point. And then, is there an after to CECL? Because one of the things that I try to highlight to you today was that the accounting rules on this subject have shifted over the last 50 or so years. They've gone from, recognize this at the very latest point to recognize this very early, but not on day one, to recognize this much later, to recognize everything on day one. It's moved all over the map. where will it go further? I don't think that the transparency is there. I think there's a lot of complexity in this accounting rule. So I think in the long term, analysts are going to push for, and the accountants are going to probably push to adjust this accounting rule in some way. Maybe move the U.S. banks towards an IFRS 9 model, perhaps. But we'll have to see. I think we first need to get through the current problem. So with that, I'm going to end it. I thank you for your participation, listening to me rant on about this topic, but I thought you'd find this of some interest. Bruce, if there's any questions, I'd be glad to answer.
All right, great. Ethan, thank you very much. And we do have a few questions here. So let me address those. Okay, here's a question. Have you seen any community banks early adopt CECL? If so, what are the reasons for this year? What are their biggest challenges?
Okay, so the answer to that is no. Community banks have not adopted it if they didn't need to. There was, depends on how you define community banks. There have been some regional banks above $10 billion that adopted it because that's when their fiscal year was. But I've seen nobody voluntarily adopt CECL if they didn't have to. It's more complex. It costs more money to run. I think there are a lot of community banks were hoping that maybe it'll stop at CECL or reverse it, which I don't think will happen either. But again, it's a muddle.
Okay, here's another question. I have heard that the ACL for some banks actually declined under CECL. This seems counterintuitive to me. I don't understand how life of loan loss estimates can be less than the loss estimates under the incurred model. Is there something that I'm missing?
Well, again, I think that what I was trying to emphasize before was that there is a model that I'm using that has a specific adjustment that weighs in where I am in the credit cycle and how severe that credit cycle might be. So the ACL would go down if my earlier estimate of the severity of the credit cycle or the credit losses that I thought I expected to face, that early estimate was revised lower. And that's kind of what actually happened here, what we saw in the fourth quarter. Just to go back to one of my slides. You see already with the U.S. institutions that by the third quarter of 2020, there was some step back in the reserves. Citi released a few million. JP Morgan, you see, released. You can't really see it in this graph, but it is actually a little bit lower. I can try to give you some of these numbers. So again, long-winded answer to your question.
Okay, here's another question. Isn't it better to say less provisioning for loan loss than reversing prior period loan loss? Better earning and easier lending, capital ratios maintained?
Sure, I agree 100%. I think the industry does as well. FASB believes that everything should be recognized on day one, so that there's no question. It's uniform. Everybody knows that on day one, all the provisioning will be recognized, and there's no nuances that are not transparent between your practices for when you start recognizing that loss and my practices.
Okay, here's another question. If you are familiar with firms that buy debt portfolios after they're distressed, and if so, can you comment on 310-30 versus Cecil?
Okay, I'm not familiar with 3-10. I don't know what, I'm not sure exactly what that question refers to. So if you're talking about banks that buy distressed loan portfolios,
yeah, that's.
Or are you talking about non-banks that buy distressed loan portfolios?
Yeah, they're talking about ASC 310-30, which is an accounting standard for and it's a non-bank for non-banks.
Yeah, I'm not. I mean, so like I emphasized before, accounting standards don't matter unless you need to meet regulatory capital ratios. So the accounting is the accounting if you're a non-bank. The accounting really matters if you're a bank.
Okay. Here's another question. We're up to
Wait,
Basel.
wait, is that clear? Does that answer your question?
I hope so.
Okay.
Again, if it
Sorry,
doesn't,
we can't hear from the guy who asked it, but okay, go ahead.
that's okay. Well, I'm sure.
If there's
Okay.
any follow-up, you guys can email me. Glad to respond.
Yeah, yeah. It might be good to take some of the nuances offline. So
Sure.
that's good. You can send me an email, and I can certainly hook you up with Ethan, or and that might be the best way to do it. Here's another question about. Do you think there will be a CECL 2.0?
I think there'll be adjustments to CECL. Like I indicated, I think that maybe CECL 2.0 could be IFRS 9. By the way, I mean, just as a response to that too, the other hand of this is that FASB actually adopted CECL because they thought it was simpler than IFRS 9. As I was describing to you buckets 1, 2, and 3, I could start to hear myself say, oh, you know, this is more complex than CECL. But you know, right now, the largest banks have adopted CECL. By the end of this year, most non-public institutions will adopt CECL, and I think by the end of 2022, even small companies will be adopting CECL. It's a benign accounting rule and just a cost. I don't really see much change or impetus to change the accounting rule. But if, you know, like the reason why Congress came in and stopped CECL from taking effect for smaller banks is because they were concerned about the impact of of COVID and the disruption on these numbers and what it would do to capital ratios and force institutions, mostly smaller banks, to not be able to make loans. If that's not a problem, if we're in a relatively good growth economic environment over the next couple of years, then this is sort of a moot issue. It's just an accounting thing. But again, it all matters. Am I a bank or a non-bank?
Okay, we're sort of reaching that magic 1 hour mark. I know people probably have other things they want to do here. So this is a last call for questions. All right, looks like we have also run out of questions. So that being the case, Ethan, thank you very much for putting all this together. And I'm
glad you guys, thank you.
I'm sure there will be 2.0, 2.1, 2.2. I mean, the accounting profession always likes to tinker with these things. I mean,
that's for sure.
Yeah. So, all right. With that, oh, wait a minute. There's one more question here.
Okay.
Let's see. So, at the end of the day, will CECL lead to redlining certain industries and either create non-regulated financial institutions or cause governments to step in?
I'm not sure I really understand this question. Redlining of certain industries, that's what I was expecting 7 or 8 months ago, that we'd see the credit card lending move from banks to non-banks. So far, that's not really been the case, and the CEOs of the banks that do credit card lending have continuously indicated that they like the business that they're doing. But COVID we don't really know what the economic story. I think it's really the economic story that will drive the wanting to avoid certain industries versus others. I don't think it's easy to make a loan to a hotel or to retail. And those things were all true beforehand, by the way. They're just more true. So I think generally the combination of this accounting rule and capital rules will force a more lending to move from banks over time to non-banks. But that hasn't really happened yet. It's more what's going to come.
I mean, I would only put in my 2 cents to say that lending as a business line is sort of a high volume, low margin business, especially on a risk adjusted basis. I think one of the things I've seen, and Ethan, maybe you can tell me, but a lot of the
credit card loans are high margin.
You know, well, and banks are also going into wealth management, certainly into what I'll call non-lending services,
right,
which have higher
only
margins.
larger institutions are able to do that. But you're right. Yeah.
Yes. Yeah. No, that's true. That's the other. I think that's the other interesting thing. I'm digressing a little bit. Is that what do we have? We have still 9,000 banks in the U.S.
No, we have 4,700 institutions, 4,800 institutions.
Okay.
So we've had quite some shrinkage.
How many banks does Canada have?
Oh, well, different banking industry, also smaller population.
No, yeah, it's about.
We do have 320 million people here. That we have like 10 times what they have.
No, that's true. But I think the last numbers I saw is that what the top 50 banks, top 100 banks, whatever, are what 80–90% of the market. So
that's absolutely correct. Yep.
So I don't know. I think there is a lot more shrinkage to come. Okay. With that, I think we're going to cut off now. And again, any more questions? Since you did write them in, what I'm going to do is I'll forward some of these to Ethan, and he'll reach out, or you can reach out to me directly, or reach out to him with the questions that I have. And I'm sure Ethan will be glad to take those offline. Okay, so
thanks, Bruce.
Thank you all. And if again, any more ideas about follow-up, so we can devote perhaps another session to it sometime in the future. All right, I'm going to end the webinar. Thank you all.